Most of you by now know that I named this channel Investing Against the Grain because I have this philosophy of going all in to companies, to stocks that you truly understand, truly believe in. As most of you know, I'm essentially all in with Tesla. I'm all in with real estate in the city I live in here. And I believe very much that you don't have to be diversified as long as you do your homework. If you look at the first video I ever made, it's with Warren Buffett and Charlie Munger, rest in peace. Them essentially saying that diversification is a hedge against ignorance. And I agree with that. If you don't want to do the homework, if you don't want to understand the companies you're invested in, not financial advice, but I would tell people to go and look at the S&P 500. There's a very good trajectory there. But if you want to do homework, if you want to learn, if you're into this, if it's a passion of yours, then I think planning for plan B is planning to fail. I believe in letting your winners run. I believe in really finding grade A companies, which, to be frank, there aren't that many of, and going all into them. My history is doing that with Apple. I did that with Amazon, and now I'm doing that with Tesla. What's next? To be frank, I think it's just Tesla, but we will see. Now, that is why I named it Investing Against the Grain. But over time, what I've noticed is that there is another attribute that is really against the grain. You see, many people like to listen to the naysayers, to the people who can play devil's advocate or just contrarian. And what tends to happen is we listen to those people and they tend to be wrong over and over and over, or they'll have a 50% success rate and they're nothing special, right? You can look up, if it's an analyst, you can look them up at tip ranks. If you watch CNBC, you can see how accurate they are there. In life, you can see just based on where are they in life? How have they done? What's their success rate? And for some reason, we tend to listen to these people. So I believe in listening to people who have been right over and over and over again. That's a philosophy I have, as you all know. That's why I love Elon Musk, because everybody doubts him. Everybody else has been wrong. The man was able to have us pay for things over the internet. They said it was impossible. Nope, not impossible. He is created his own rocket company, SpaceX, relanding them. You guys know the story there. Tesla electric vehicle, you know the story there. FSD, you all see how that's all playing out. So I believe in listening to people who've been right over and over. I listened to Ron Barron, for example. He's been right over and over again. Tom Lee, he's been right over and over again. The All In podcast, those gentlemen have been right over and over again. Look at their businesses. They've been highly accurate, highly successful because they're right a lot. So today we are going to talk about recession. Is it coming? The market's closed today, so it's a great day to look into this and to discuss what may be happening moving forward, because we are kind of at an inflection point, and I want to make sure that you all can at least see and hear my point of view when I listen to many of these people. So we're going to listen to 3 videos, okay? 2 of them are longer. One's really short. We'll kick off with that one first. But today's focus is about inflation, it's about recession, and just in general where the economy is going. Because if you don't know that, then you can't properly prepare. None of this financial advice. We all have our own timelines, our own trajectories, our own goals. All right. Some of us are older and looking to retire. Some of us are younger, looking to take on more risk. Some of us want to retire early. Some of us want to retire early, but with abundance. We're all in a different place. Some of us are just trying to get out of our own debt. So take this just as information. And, from someone who I like to think I've been pretty successful, I like to think I've been right a lot. I'm showing you who I listen to, how I listen to it, and how I take in what they're saying. So, with all that preamble out of the way, and we're going to kick this off with Milton Friedman, arguably regarded as the most famous, most influential economist of our lifetime, some of our lifetime, of the 20th and 21st century. So let's listen to him talk about inflation. So let me share and let's hit play.
In a recent interview of U.S. News and World Report, Secretary of the Treasury Blumenthal blamed our current rising inflation in a large part on our foreign trade and unions. He did, however, say that the government was little to blame. Would you like to comment on that?
Yes. Unfortunately, it is one of the defects of our political system that we always put a Secretary of the Treasury and other high government officials into a position in which, when they make public statements, they are almost driven. Well, what's the word I want to use? I want to use a polite word, equivocate. Secretary Blumenthal knows as well as you and I do that inflation does not come from trade unions. That doesn't mean that trade unions aren't grasping. Of course they are. But they don't produce inflation for one simple reason. They do not own a printing press on which you can turn out green pieces of paper. The only such printing press is in Washington. I say printing press, of course, in the modern age, we do it in a more sophisticated way. We use bookkeepers and accountants and computers. But it comes down to the same thing. Inflation is made in Washington because only Washington can create money. And any other attribution to other groups of inflation is wrong. Consumers don't produce it. Producers don't produce it. The trade unions don't produce it. Foreign sheiks don't produce it. Oil imports don't produce it. What produces it is too much government spending and too much government creation of money and nothing else. Yes, sir. Before you clap, let me point out that the reason why we have too much printed spending and too much printing of money is because you people want it. You and I, we're citizens, we run this country. If Congress has been voting higher and higher spending, why? Because it has been politically profitable for them to do it. If they have been voting higher spending and not voting the higher taxes to pay for it, why? Because it's been politically profitable to do it. We would all like to get something for nothing. And so the political process has been leading to Congress increasing spending, not increasing taxes, and financing the difference by the hidden tax of inflation. I think we are unwise. But let's not blame the others. The problem, in that famous statement of the cartoonist, we have met the enemy and they is us.
So powerful words there, in my opinion. That, again, is Milton Friedman, regarded as, one of the best economists ever. All right. And so the reason I want to start off with that is I want to make sure that we are framing things in the right lens. Okay. We'll get to this in a second. When it comes to inflation, the government's the one that creates it because they print money. And what does that do? Well, that puts in a oversupply of money. And so too many dollars chasing too few goods. So we can't produce things or give enough service fast enough to keep up with the amount of money that's out there. And so what happens when that happens? Well, that means that there's an immense amount of demand because so many dollars are out there, but not enough supply. So that means I raise my prices, right? So this is the imbalance. And this is largely what we have. This is not a Democratic thing. This is not a Republican thing. This is apolitical, all right? Both parties, really since Bill Clinton's, I think, second term, has ran an increasingly a higher deficit every single year, right? So this is a government problem, right? Republicans, Democrats, Green parties, independents, Tea Party, whatever party, whatever group you want to be a part of, you are part of the problem. Now, government creates it, but as Milton Friedman said, we are the ones that keep electing these people and not holding them accountable on a budget. So this is really important for us to understand where inflation comes from. If we keep putting all this money out there and we can't build things fast enough, well, what do you think they're going to do? They're going to raise the prices because they can't keep up with the demand because supply is so low. And so we need to take that money out to slow things down, to slow down the demand, to let supply catch up and find an equilibrium. So with that, let's dive in. Let's listen to the All In podcast guys. We'll bounce around a little bit here. We're going to start off with Jason, and then we'll listen to what the other guys have, and I'll give you my point of view as we go through this.
Your 10-year chart super easy to explain what's happening here. Rates were low for a long time. Inflation cruising at about 2%. And then lunatic spending during COVID. And we added $8 trillion to the national debt. And then Biden added a bunch, everybody getting the stimmy checks and PPP loans. And so if you look at inflation here, we were just cruising along at 2%, massive spike up to 9% year over year inflation, and now coming back down to 3.x. And the question is, can we get to a 2 handle? And the rates went up faster than ever in history. Here's the Fed chart. You can see there and this goes from the 80s. So you see that massive spike when they tried to break the back of inflation previously. So this is the fastest ever gone up. And here we go. The common sentiment here is that savings has been burned off and people are starting to have debt. And so now we are in Act 2, the lowest unemployment rate of our lifetime continues. If you believe those numbers, some people do, some people don't. Labor Department reported 272,000 new jobs in May, crushing the 190,000 estimate. And then Act 3, average hourly wages up a massive 4% from last year at $35 an hour. That also topped estimates. So if inflation is at 3.x and hourly earnings are 4.x, maybe consumers will start feeling better about the economy eventually. They obviously have been pretty shocked by that 9% inflation and only 4% growth. Here's your chart from Fred and the hourly earnings of all employees. And you can feel pretty good about that. Everybody's wages keep going up. The question is, do they go up faster than inflation? Okay, so there's my framing of the situation.
Let's clarify what Jason just said. He said essentially unemployment is at historic lows. He says inflation is cratering. Hourly wages are going up. Minimum wage is going up. And so people should be happy with the economy. And this is really what you hear the White House framing out right now, that things are better than you expect, but people feel a different sentiment. And I would say people's feelings are also different than just the economy as a whole and what's happening.
Chamath, what's your take on this? We have a slowing GDP growth. We have inflation going from 9 down to 3. We have wages going up 4%. How do you make sense of all this? You feel like,
Sorry, Friedberg, are you saying we're going to have stagflation, or
we have stagflation right now, definitely. But what I'm saying is that it's not a rosy picture just because labor rates are going up. If the labor rates aren't going up, and you can see this ultimately, the best number for this is the sum of GDP growth. So in aggregate, if the revenue of everything combined, which is GDP, isn't going up faster than the increase in the cost of everything, people, businesses, and the government can't afford their stuff. And that's fundamentally what's going on right now. What we need to see is a normalization where GDP growth is greater than inflation rate. And as soon as that happens, then we have a more normalized and stable economy. So right now, things are not stable. There's a lot of difficulty and strain in the system.
I will put myself on the other side of that trade, if there was one. If I had to simplify the United States economy, remember, GDP is 70% spending by individual people. And so people can spend two things: savings that they have or credit that they have. And what's interesting is that we have finally burned through, and this is what this picture shows, all of the money that folks had in their bank accounts. And so what does that force people to do? It actually forces people to re-enter the workforce so that they can start to make money. But the problem is that companies have been shrinking and have been on a defensive posture.
You've heard me talk about this a lot, that the whole idea that we're just spending our savings, or, you constantly hear people say that it's the stimulus checks or that people are still spending. Look, the stimulus checks weren't that much money. All that money got spent in probably the first month that people got them. I think what we've been seeing is what Chamath alluded to was the credit. And I think now people are capped out on credit card spending. And so I think that's really what we're seeing here. And as that happens, and we have more and more layoffs, and we have less and less job openings, you get into this weird place where, okay, I have all this debt, I don't have any savings, I just got laid off, and I can't find a job. What now? You're in trouble.
And so as a result, which you started to see this past unemployment report, unemployment is now ticking up because when these people re-enter the workforce, there are no jobs for them to have. People are filing incremental unemployment insurance claims. States like California, in fact, the state of California was the worst off this past month. So I think what we're starting to see is that for the large portion of the economy, we've run out of cash to spend. And as a result, I do think that we are going to see an economic slowing. And I think that that will create not just enormous empirical justification for Jerome Powell, it'll be exacerbated by what Friedberg just showed, which is the political pressure that he's going to be under to cut. Will it cause him to cut more aggressively than he would have otherwise? On the margins, I actually think yes.
Mhm.
But my perspective is that I think that we've run out of money, individual people. So I think unemployment is going back up. I think GDP is going to shrink.
Yep.
And so I kind of tend to be in this camp that we're going to see more than one rate cut.
You guys have been hearing me say this, like Chamath said, on the margin, it'll give him incentive to reduce rates by a more aggressive way. That's what I've been saying, right? That I think what's going to happen is something's going to break. There's going to be a scare, or the data is just going to come in so crazy bad that they're going to be forced to do more than just a 25 basis point cut. Now, I do think the first cut will be that. It's the following one after that where I think it'll get ratcheted up. So right now, the Fed is anticipating doing one rate cut this year. Essentially, it's going to be December. It was 2, and at the beginning of the year, it was 7. So in the meantime, we are seeing inflation come down. We're seeing jobs numbers our unemployment job numbers tick up. So you're starting to see this accelerate, right? Before it was like, oh, we're doing all this and nothing's happening. The lag effects, you remember that phrase? Well, these lag effects are beginning to not lag anymore and starting to hit the bottom line.
There is total job openings. To your point, Chamath, they're getting burned off. We peaked at 12 million. Again, if you believe the numbers or not, they obviously have some value. And we burned off a ton of those. So, Sachs, what's your non-political, nonpartisan take?
So okay, two things here. One, again, look at this chart. This chart shows you the job openings. So essentially, if I go onto a company's website, how many job openings are there? Now, we know for a fact that this is artificially high. Why is it artificially high? Well, because companies were struggling to get employees, right? We had an issue, if you recall, where people weren't coming back to the workforce. So we had a workforce participation issue, and we had an issue of getting good talent, or the unique talent that people needed. And so companies started to just leave job recs open. Even if there wasn't actually a job rec, they would just leave it open so that they could get the resume and have it come in, so that they would have optionality, which is smart if you really think about it. What's the point of closing it? There really is no benefit to the company to close it. So it allows them to keep their net open, and when they're ready to collect, they can collect. But to Jason's point, whether you believe these numbers or not, the fact that you can see this coming down aggressively is signal. So ignore the actual number. Just look at the amount of openings that are declining, and that's your signal. Now, I'll rewind here a second. This is kind of comical. You hear Jason sitting here asking Sachs to keep politics out of this. But the truth is, you can't keep politics out of this at this point because although the Fed, Jerome Powell, is supposed to be apolitical, he's still a human being, right? He still has to get elected into his position, right? He has to be selected for that by the president. He still has a legacy that he cares about. So to assume that it's apolitical, in theory, that would be nice, but we all have our own biases, whether we know it or not.
And so I kind of tend to be in this camp that we're going to see more than one rate cut.
So here is total job openings. To your point, Chamath, they're getting burned off. We peaked at 12 million. Again, if you believe the numbers or not, they obviously have some value. And we've burned off a ton of those. So Sachs, what's your non-political, nonpartisan take, first principles of what's going on with the economy?
Well, look, we just had this inflation report. CPI was 3.3%. The market was expecting 3.4%. So that's a teeny bit better than expected, but it's still persistently sticky. Inflation is. And furthermore, Powell's comments were very hawkish. He basically said he could not commit to when rate cuts might begin. And we're ready. Remember, at the beginning of the year, we entered the year with expectations for 7 rate cuts this year. Now we're down to an expectation of 1 rate cut. And we can't say for sure when that's going to happen. So honestly, I think your introduction overstated how positive this news was. And that's why I think if you look at the markets right now, it's very mixed. Most tech stocks that I'm seeing are actually in the red. And a few of them like Tesla and Apple and Nvidia are up, but the vast majority are in the red. So I think the market is taking this in stride. I think the big picture here is just we don't know when rate cuts are going to begin. And I think that Vinny Lingham had a really interesting take on this actually, where he said, look, could Powell cut by a quarter point? Would that matter that much? No, it wouldn't matter that much. But the point is, Powell doesn't want to say that the rate hike cycle is over, right? If he were to cut by a quarter point, that by itself wouldn't do much, but it would be a huge statement that we're out of the woods on inflation. There's not going to be any more hikes coming, and we're beginning a new rate cut cycle. And Powell is clearly unwilling to say that. We're still in this like limbo where he is saying that we don't know when rate cuts are going to begin.
Betting markets had a 70% chance of 2 rate cuts before Powell spoke. Afterwards, now it's 1 rate cut. Dow record high again this past week, and NASDAQ record highs each of the last month or last 4 months. So the market, putting aside individual stocks, has broken records almost every month for the last 3. Freebird goes
on the back of like 2 stocks. I mean, Nvidia is holding up the whole market. There's a lot of funny memes about this.
And
the
Apple,
AI stocks are holding up the whole market.
Correct. Yes. Record stock market.
What does Jerome Powell have to gain or lose by bowing to political pressure? So a lot of folks mention and reference his kind of there's political pressure for him to do something, but why would he bow? What does he care? What do you think the motivation is for Powell individually? And what is the political process that will ensue if he doesn't bow to political pressure? I think it's the legacy and the perception that he leaves behind. I think had he not overpromised and underdelivered at the end of last year, remember he was promising, as Sachs said, 6 or 7 rate cuts, and he's delivered bupkis. And the markets were none too pleased. And so now I think he's just swung the pendulum to the other side, which is he's going to massively underpromise and then overdeliver if he can. And so as a result, I think he's being much more measured and guarded. I don't think he wants to be wrong here. So I think he's thinking about what most folks think about when they're at the tail end of a job like this. He's not going to get reappointed. He's going to go off into the sunset. It's roughly about how history will write how he handled the transition from that to the next phase, whatever that is. So I think he's probably very interested in making sure he doesn't break the economy, and also that he doesn't seem like he's constantly waffling and unpredictable. But isn't he just an autonomous agent that is meant to respond to the data? I guess I'm not quite understanding the degree of judgment and discretion that everyone seems to think he has. They have a mandate, but
if you're asking what his incentives are, I agree with Chamath. I think his main incentive at this point is concern for his historical legacy. And specifically, he wants to be thought of like Volcker, not like Arthur Burns in the 70s. Volcker basically crushed inflation even at the cost of recession, and he is worshipped today as the best Fed chair ever, whereas Burns let inflation slip the leash in the 1970s, and he's not thought of very highly. So I think that Powell's main concern here is with his historical legacy at this point. I don't think he's expecting to be reappointed. He's wrapping up.
So for those who, have followed me on this channel for a while or see me on other channels, you know that I've been saying this for quite some time, that at this point, Jerome Powell knows that this is his last sprint as Fed chair. And so really, he's not worried about getting reelected. So I don't think he has political pressure at this point. At this point, he could care less about politics. At this point, it's just about his legacy. Right now, his legacy doesn't look too great. In fact, it looks pretty bad. But he could end on a high note. And if you end on a high note, well, the truth is that might be all that people remember. So I think that's why he has no problem over-indexing on going into a recession or breaking something, because he has a very strong tool at his disposal, which is being able to cut rates and really stimulate the economy, right? Inject it with money. However, you can't really go the other way. If you cut too early and you reignite inflation, you just really let the genie out of the bottle. And then you add in the fact that we have to finance a lot of our national debt coming up here soon. We're already spending $1.2 trillion on interest. That's way over what national defense is, right? There's a problem on that end. So it's smart to over-index on a recession, breaking something, because you'll be safe on the recovery from that. Whereas if you go the other way, you might not just be the Fed that caused inflation, couldn't break inflation. you might be the Fed that really screwed us over when it comes to our national debt and interest payments. Again, it's the government's fault, right? But it would kind of be put onto your shoulders because, well, now we have to raise rates again. And that means our interest payments are going to be even higher. And it's just a snowball effect. You don't want to be that Fed. That's for sure.
Wrapping up his second term already. Now, I think if you go back to 2021, the incentives were a little bit different. Powell wanted to be reappointed by Biden. And remember that in the summer of 2021, that's when the inflation began. We had that surprise 5.1% inflation print. Powell was up for renomination and confirmation in November of 2021. And I think what happened back in that year is the administration downplayed the inflation report. They called it transitory. Yellen did, Biden did. And so Powell had to get on board with that message if he wanted to get confirmed by the Democrats. And he did get on board with that message. He repeated the whole transitory point. And for that reason, they didn't begin the rate hike cycle until March of the following year. And from that May inflation print to November, they kept doing QE, even though we had inflation back in the system. So I think that Powell was actually intensely political in 2021. He knew who was going to reappoint him and who was going to have to confirm him. And he got on board with that message. And that's why they were so slow to react to the inflation. And I think it was disastrous. And that's one of the reasons why the rate tightening cycle was so steep, is because he had to catch up with all this inflation that he had allowed for 9 months longer than he should have. But if you ask me what's his incentive now, I think it's purely about legacy. And he does not want to let inflation come back after cutting rates a little too soon. So his incentive, I think, at this point is to make sure that he's not wrong again about inflation.
Exactly right. So like I said, it's what I've been saying for many months now. And again, this goes back to it's supposed to be apolitical. Sure, we can say that that's how it's supposed to be. But when you have to be reappointed, I said elected earlier, reappointed by the president, how is that apolitical? If that president has to appoint you, obviously that president is going to want somebody who's aligned with how they see things from an economic perspective. And again, for listening to people who are right a lot, Yellen was wrong. Janet Yellen's been wrong a lot. Biden's been wrong a lot. So, and again, this is not a Democrat or Republican thing. It's an individual person. What's their track record on being right or wrong on things? And they've been wrong. So why would you continue to listen to people who have been wrong over and over? Listen to the people who have been right. That's just my advice.
And to remind everybody, maximum employment, stable prices, moderate long-term interest rates is the mandate for the Federal Reserve. They're supposed to be independent. Famously, Reagan pushed Volcker to get rate cuts. And there is a lot of politics involved in this. And so legacy does seem like the organizing principle here. I would agree with Chamath and Sachs that it's legacy, but there's always political pressure here. As you can see, Elizabeth Warren is trying to push him to make cuts for obvious reasons.
Well, no, there's politics when they're up for appointment or for reappointment, for confirmation, basically, because they want to get that vote.
Yes,
but
there's also subtle pressure, and then there's letter writing like Elizabeth Warren's doing here, right? So the pressure can be there. The question is, do they bow to it, right, Sachs?
Yeah, they don't have to. I mean, the Fed's independent.
What do they stand to gain or lose by the pressure is my question. And I'm not sure I really like this concept. Exactly. And I think that's really where there's a important point to note here, that you can identify the guy's motivation and how he's going to operate.
This year, because there is no political pressure. There was in 2021, and I think that's why he was slow to react.
Yeah,
right.
Listen, if Powell can stick the landing here, then his legacy comes out intact. But if he screws this up, and then he was slow to react to the inflation back in 2021, 2022, his legacy is going to be mud. So I think he's going to be more concerned about erring on the side of tamping down inflation than erring on the side of the economy not doing as well.
Yeah,
I think those are the incentives.
My position is I think he might have already stuck the landing. I think like the fact that we've burned off all that savings, to your point, Chamath, that people are going back to work, and that these businesses are doing fantastic and efficient because of AI and other gains, it feels like all
people
the
are trying.
I think he's stuck the landing already.
Stocks that are, no.
Yeah, they're trying to go back to work, but the jobs don't exist.
I think they're going to take jobs. They just might get the job they want. And that's what I think people have to recognize is they have to take a job, and it may not be the one that they want, working from home.
We could have a negative recessionary print going.
All right. So that is the silliest statement I've ever heard from Jason. There are plenty of jobs. They just might not get the job they want. Okay. That's not exactly true, right? People aren't just going to take a job at McDonald's because they need a job or they want a job, right? Like I don't know. It just seems like he's in his ivory tower saying this. Like, well, there's plenty of jobs. Go find a job. Go work and make your $15 an hour, $20 an hour, whatever it is nowadays, minimum wage. That's not the same, right? When people get laid off, they probably have, and most people getting laid off are tech workers, right? Really high salary jobs. And you expect that person to go and just work at a McDonald's or whatever? Like, no way. That's not going to happen. That's not even going to cover their bills, right? So it just breaks the system is the problem. So I think Jason is a little, I don't know, he's being a little callous on this front. So let's see what Chamath says.
Going into the election cycle. I think that's very possible. Yeah, exactly. Have a negative recessionary print going into the election cycle. I think that's very possible. Yeah, exactly.
I don't know, Jason. Look, I'm hearing a lot of happy talk right now, and I agree with Friedman. You had 1.3% GDP growth rate with a 6% of GDP deficit by the government. If the government wasn't printing so much money, wasn't overspending, if you were to have a balanced budget,
it would be a recession.
Yeah. Think about that. Just
It would
subtract
be
the
negative,
1.2%.
it would be negative GDP growth if not for the government's program stimulating the economy.
And a lot of the jobs you're talking about are government jobs. The government is creating jobs like crazy, not in the private sector.
Look at this. How crazy is that? That's government employees. So to their point, if you took out government employees, government stimulus, we'd be in a recession today. Think about that.
For the public sector, because it is an election year. So there's a lot of political forces propping things up. And I wonder what happens after the election.
All right. So what happens after the election? That's a very good point from David Sachs. Well, after the election, if Trump wins, he's going to obviously keep or extend the tax cuts that we all benefit from today. If you think you don't, trust me, you do. I still remember, must have been 2017 maybe. I forget. But me and my, a few of my best friends, we were sitting there looking at our check, and we're like, oh, look at that. We make more now, right? Because of the tax cuts. So everybody will see a hit to that. Everybody. And so that will probably put another $1 trillion in debt. But we got to get our handle around our debt as a country, our deficit. It's just out of control. We have to balance our own budget. It's at a very pivotal point, I think, because if not, we're going to have crazy taxation. We're going to have many people leave the country. I mean, it'll just be chaos, right? And the craziest part is that we don't have to do this. We can fix this problem, but Congress, the White House, Washington have to get on the same page, right? Everybody's so worried about their own legacy, and they want to be able to send checks out with their name on it. They want to be able to do the bidding of this lobbyist or that lobbyist, or be part of the unions or the oil companies, right? It's nonsense. We need to have leaders who care about the country and want to fix this problem once and for all. Whatever leader or leaders come in and fix this problem will go down in history, for saving our country. All right. So we're going to leave it there. I did have another video I want to watch, but I think we're a little long in the tooth right now. So I'll do another video going over it. You can see here that there's a lot at hand. And if the government wasn't really trying to prop up jobs and GDP, but through spending and through hiring, we would definitely be in a recession. To Jamal's point, we could be going into the election in a recession, right? Or printing or having a recessionary print, meaning negative GDP. So the reason I think this is so critical, I don't know if we're going to go into recession or not, technically. I think many of you know, I've been saying we've been in a recession for quite some time now. Probably since last year, I think we've been in a recession. And the Bureau, I think it's Bureau of Labor, I forget what they're called. They're the ones that have to officially decide if we're in a recession. And normally they're deciding that we had a recession tends to be after the recession's over. So a lot of times you're in a recession, but you don't know it yet because it's not official. So keep that in mind as well. But my worry is that things could get amplified after the election. The reason is whoever goes in there needs to stop government spending, needs to stop government hiring, and that could really kind of take the lipstick off the pig and show you what the economy really looks like. Also, don't forget that right now, if you were to take out the housing component of CPI, we've been under 2% for a long time. So that's a huge red flag, because owner's equivalent rent it's kind of screwed up the way we do it. The way we base this off of is we look at January, and we look 6 months out, take those 2 months, and we average it out. So a lot of our data is extremely old when we look at it. So we might already not be in a recessionary or an inflationary position with our housing, whether it's rental or owner's equivalent rent, but it's not in the numbers yet. And so the Fed still keeps doing what they're doing. And then you have the added component of Jerome Powell and his legacy, and knowing that he can't screw up on the reinflation side, or he's just screwed. So take this episode, especially if we stuck to the end here, as listening to the people who have been right over and over. Listen to David Sachs, listen to Chamath, listen to David, listen to Jason. Don't listen to me. Just I want to show you some of the people I listen to and how I think about what they're saying. Then I would also say continue down the rabbit hole, right? Sachs put up a couple people from X that he had little screenshots of and their point of view. Listening to so people who are right a lot, listening to who they listen to is also a really good indicator to understand how they're thinking and see where they're gaining their information from. All right, I'm gonna leave it there. Different kind of video today, a little more economic based, kind of reviewing what four extremely highly successful entrepreneurs in the United States, their point of view on all of this. They don't all agree. But you can see they're respectful and they all have a very interesting take. So let me know what yours is below. Are we in a recession? Are we going to recession? Will we have a soft landing? Who's going to win the election? Will that have an impact? Is Jerome Powell doing this for political reasons? Is he apolitical, or does he care about his legacy? Let me know all down below in the comments. All right. Appreciate all of you. Thanks for tuning in. Peace.